Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Welcome to Modern Investing Techniques, episode 69. I'm Patrick in Vancouver. Today is June 7th, 2026. Here's your daily market intelligence and today's practice trade. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Looking back at 7 episodes from 2026, June 1st to 2026, June 7th, the stories that mattered, what we learned, and what to watch next. Markets opened the week mixed with the S&P 500 at 7,581, the NASDAQ Composite at 27,018, and the TSX Composite at 34,677. Oil climbed on renewed Iran tensions while U.S. equities held near records. Our simulated portfolio sits at year-to-date plus 1.44% versus NASDAQ year-to-date plus 16.28%, leaving alpha at minus 14.84% year-to-date and minus 19.32% since inception. The S&P 500 later closed the week at 7,384 after a 2.6% drop, the NASDAQ Composite at 25,709 after a 4.2% drop, and the TSX Composite at 34,414 after a 2.3% drop. 16 days after the APO insurance float entry closed minus 1.81%, the position reminded us that even attractive valuations need sustained catalysts to outperform the benchmark. About 14 days ago, we picked PYPL on durable free cash flow and buybacks, and it closed plus 0.14%. 15 days ago, we entered CNR after a multi-year correction, and the position closed plus 8.66%. Royalty acquisitions let investors capture cash flow exposure to operating mines without funding exploration or development risk. Summit Royalties just closed a 1% net smelter return on Newmont's Saddle North deposit for 5 million Canadian dollars in shares, giving direct participation in future production at a fixed cost. This structure works best when the underlying asset has proven reserves and the royalty holder maintains low overhead. Investors can screen TSX Venture royalty companies for similar deals that deliver production-linked returns with caped downside. Custom indexing lets investors build a fully personalized index portfolio without paying management fees, a structure Questrade just launched for Canadian accounts. The approach combines the low-cost, rules-based nature of indexing with the ability to exclude or overweight specific sectors inside a TFSA or RRSP. Geopolitical premium investing involves overweighting assets that benefit from policy shifts, such as tariffs or critical mineral demand, rather than broad market beta. Today's proposed 10 to 12.5% duties on 60 trading partners and the Canadian antimony discovery highlight how quickly supply chain security can reprice entire sectors. Share repurchase expansions create a direct capital return mechanism that can support share prices even when broader markets stall. Shopify's $3 billion increase to its existing buyback program illustrates this approach in a high-growth software name trading at elevated multiples. Investors can screen for companies announcing or accelerating repurchases by monitoring TSX and SEC filings through platforms like TMX Money or Edgar. Fed speakers emphasizing the duration of the balance sheet over its size point to a refined approach for fixed income allocation. Duration mismatch between the Fed's holdings and outstanding treasuries directly influences term premia, so investors can adjust by extending ladder maturities when real rates compress. Non-farm payrolls act as a high-frequency gauge of economic momentum that directly shapes sector rotation decisions. When actual hiring exceeds consensus by a wide margin, as it did with 172,000 jobs versus 85,000 expected, markets typically reprice the path of interest rates higher, boosting financials and value stocks while pressuring growth names. Index reconstitution creates measurable short-term price pressure on both additions and deletions because passive funds must rebalance holdings on or before the effective date. Today's announcement that Marvell and Flex will join the S&P 500 while Pool Corp and Campbell's are removed gives active investors a narrow window to front-run the mechanical buying and selling. Since we last covered royalty structures, the ongoing story shows they continue to offer targeted resource exposure without operational overhead. And that matters for TFSA holders seeking cash flow participation with defined entry costs. The custom indexing launch on Canadian platforms remains relevant because it lets investors tilt away from tariff-exposed names while staying inside registered accounts, which directly addresses the policy uncertainty that surfaced midweek. Geopolitical premium positioning gained urgency after the 10 to 12.5% duty proposals, and what this means for investors is a need to monitor critical mineral discoveries like the Canadian antimony find for potential sector repricing. Share repurchase programs such as Shopify's $3 billion expansion provide defensive support at elevated multiples. And the practical consequence is that screening TSX and EDGAR filings can surface names where capital returns may cushion volatility. Fed balance sheet duration focus continues to influence term premia, and listeners holding fixed income ladders should watch whether real rates compress further as inflation expectations rise. The May jobs beat of 172,000 positions continues to tilt sector rotation toward financials and value when the surprise exceeds 50,000, and this remains a simple spreadsheet check for TFSA allocation decisions. Index reconstitution flows into the June 22nd effective date created short-term trading windows around the Marvell, Flex, Pool Corp, and Campbell's changes, and what this means is that mechanical rebalancing can produce front-runnable price pressure even in volatile weeks. The single most consequential development of the week was the combination of tariff proposals and the jobs beat, both of which reinforced the need for tighter catalyst screening after our simulated portfolio posted alpha of minus 14.84% year-to-date. What to watch for next week is whether volume confirms follow-through in AI-related names or signals a stall after the sharp Friday decline. The biggest open question heading into next week is how index rebalancing flows interact with ongoing geopolitical headlines. One practical takeaway listeners can use is to screen for royalty structures or custom indexing tilts that align with supply chain security themes rather than broad market beta. In our simulated trades this week, we entered CNR after a multi-year correction at depressed multiples, and it delivered plus 8.66%. Showing that patience on cash flow visibility can still pay when the thesis aligns with improving sentiment. The APO position closed minus 1.81%, reminding us that even attractive valuations need sustained catalysts to outperform the benchmark. HD closed plus 4.86% after an earnings surprise and reaffirmed guidance, and that outcome reinforced the value of visible cash flow support, even when broader rotation is underway. PYPL closed plus 0.14% on durable free cash flow and buybacks, and the modest result taught us that valuation support alone rarely drives sustained outperformance without a fresh catalyst. These outcomes highlight the need for tighter catalyst screening going forward. Questrade's zero-fee personalized index portfolios combine rules-based indexing with exclusion or tilt capability directly inside TFSA and RRSP accounts. Investors can use the platform's screening tools to exclude tariff-exposed sectors or overweight critical mineral names without paying management fees. TMX Money and EDGAR filings let listeners monitor share repurchase announcements in real time, and cross-referencing those with earnings transcripts adds context on capital allocation strength. Intermediate duration ETFs on major Canadian platforms allow quick ladder adjustments when Fed speakers shift emphasis from balance sheet size to duration. The week's non-farm payrolls beat of 172,000 jobs versus 85,000 expected shows how a simple spreadsheet comparison against the prior 3-month average can guide TFSA tilts toward banks or pipelines. Screening for S&P 500 additions like Marvell and Flex before the June 22nd effective date offers a mechanical window to front-run passive rebalancing flows. Our simulated portfolio cumulative return stands at plus 1.44% year to date, with alpha of minus 14.84% versus the NASDAQ. The win rate across completed trades reflects ongoing learning from volume confirmation requirements. Our AI analysis is adjusting by placing greater weight on catalyst sustainability after several valuation-supported entries delivered limited follow-through. The week's tariff proposals and critical mineral discovery together underscore how supply chain security can reprice sectors faster than broad market beta. Before we wrap, watch for volume confirmation in financials after the jobs beat when markets reopen Monday. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Models and Agents a listen, your daily briefing on AI models and agents. You can explore the whole lineup at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?